Right. So in this chapter 5, you will have a framework to think about how output and interest rate are determined in the short run. So remember that in chapter 2, we just discussed the main fundamental economics objectives. We discussed the definition of macroeconomics variables like inflation, unemployment, and GDP. In chapter 3, we discussed the goods market in a closed economic and versus open economic. Then we spoke about variant levels of multipliers. Then we say that was a short run, which means prices are sticky, wages are sticky, which means prices the supply side of the economic is not working. That every aggregate demand is what determines output. Then we talked about how to calculate GDP by having the investment is equal to savings. So that is very important assumption. And then we discussed the paradox of savings. In chapter 4, I talked about the financial market, where I talked about what determine money demand, what determine money supply, what determine interest rate. And I talked about the variant, usage of money, i.e. function of money. Then I talked about the central bank demand for money, where there are equations you are supposed to remember and know how to derive them and know what are the implications of them, right? Then in chapter 5, then we are now combining goods market and financial market, and so in goods market we will be able to derive the IS. In the financial market we derive the LM. When we combine goods market and financial market, we get the IS-LM equilibrium, right? So you will have, by the end of this chapter, you will have a framework to think how output and interest rate are determined in the short run, understand how IS, which is investment and savings, and LM, which is liquidity of money model, still represent essential building block in understanding what happened in the economy in the short run. So you need to understand how to derive IS-LM. This is not only for learning purposes, but even for your test and the exam. So understand how to determine the equilibrium output, i.e. where IS and LM intersect. Surely when you are plotting IS and LM, on the IS curve, you know that on the vertical axis, you are going to get the interest rate. On the horizontal axis, you are going to get output. Now, when we ask you to plot these things, you do get part marks for plotting it correctly. So understand how changes in goods market or financial market affect the equilibrium output and interest rate. So of course, if you derive the IS equation, it will be either output in terms of other variables or in interest rate in terms of other variables. So be able to discuss the transmission mechanism from a shock in one market to the other. Understand monetary policy and fiscal policy implication of changes in variables in both equations. So in goods market, so the good news is the guy called Hicks was actually a lecturer at VETS. So when you hear the guys who actually derived the IS once taught at the School of Economics, right? So Hicks and Hansen called the formalization of ISLM model. So let us first summarize what we learned in chapter 3. We did characterize equilibrium in the goods market as what? As a condition that production is equal to demand, Y equal to Z. We all know this. We call the equilibrium of demand and production the IS relation because it has been historically represented as what? Equality of investment equal to saving. So this was another approach where we could get. So if you say in the absence of what? In the absence of public savings, you get that your investment is equal to savings in the other approach. We will see that later, that we can actually get this relationship. This relationship is very important going forward because in third year, you will actually be able to use this to show how does changes in savings in the long run affect the growth rate of the country economy. So we define demand as Y equal to C. So this is your disposable income. Of course, Y minus T is your disposable income. We are saying here that our investment is exogenous, i.e. is determined outside the model. Using this equilibrium condition, we look at the factors that changes equilibrium. So of course, now consumption is endogenous. Why is consumption endogenous? Because consumption is a function of output and output is a dependent variable. So if this is a function of a dependent variable, then it is determined within the model, right? So we are using this equilibrium condition, we look at the factors that changes the equilibrium output, i.e. the effect of change in the government spending and the shift in consumption demand. By now you would have heard of different types of financial assets such as short-term bonds, long-term bonds, government bond, and corporate bond. And there are 1,000 differences of them. We are not going to discuss them here. So the two simplification of the model in chapter 3 then. What was chapter 3 shortcomings? First, it did assume that the economy was closed, that export and import were zero. It also assumed that this investment is exogenous, which means is determined outside the model. But those assumptions are too unrealistic. So later, we now need to relax those assumptions. So investment spending actually do depend in two factors, i.e. investment is a function of sales, i.e. sales is just the output. We are saying that there is no inventory. So your investment then is a function of your output and your income and your interest rate. Now, our investment then is positively related to your income. When your income levels are high, we invest more.
Sorry, Ezekiel.
Yes. Yeah.
I just wanted to ask, so inventory this year is scoped out.
Right.
Do you not have to worry about inventory?
Yeah.
Okay, thanks.
Yeah, so that's the inventory. We assume inventory is not, we are not making that assumption here, right? I'm just checking that if there is, okay, so everybody, I'm checking that no one is trying to get in the session while we are not here. Okay, so again, so investment spending depend on two factors. It depends on the level of sales, which is sales is literally equal to output. We are saying there is no inventory, and the interest rate. Now, surely then investment is positively related to income and negative related to interest rate. The higher the interest rate, the cost of borrowing is higher, we invest less. Now, when we talk about investment, we are not talking about financial investment. We are talking about like things like building bridges, building electric plant and stuff. Those are things we are talking about, not financial assets like derivatives and stuff, because now finance students will start complicating stuff. So no, so investment then is a function of your income and your interest rate. And it is negative, so it's positively related to output and negative related to interest rate. Now I wrote it here for simplicity. So taking into account the investment relation, we learn above, now our equation changed. So it becomes Y is equal to C, which is your disposable income plus that. Not that equilibrium in good market means that if you increase interest rate, your output decreases. So an increase in interest rate decreases the demand for good at any level of output, because of course interest rate has a negative impact on your investment, which means your output will fall. So you see now consumption and investment are all endogenous. Why? Because they are all function of Y. So of course now remember that I say investment in interest rate is on the Y-axis, and then output is on the X-axis. So if there is a negative relationship, it means that the IS curve then should be downward sloping. Which means if then we know that Y and I are on the axis, it means all the other variables, changes in all the other variables will cause a shift in IS curve. I.e. if you change your consumption, if you change your taxes, if you change your government spending, your IS curve is likely to shift either to the left or to the right, depending on what direction it's shifting. Right, so the IS curve is downward sloping. Notice that the interest rate causes movement along the IS curve, while all other variables causes a shift. So here then is how we derive our IS. This is already in the book, so please do read and understand. So if you change government spending, increase government spending, the IS will shift to the right, interest rate will increase. Now, notice that if you increase government spending, IS will shift to the right, that is correct, and what? Interest rate is doing what? Is increasing. Now, if interest rate is increasing, that interest rate increasing has a detrimental impact on investment, which means output wouldn't have increased by a larger magnitude because of interest sensitivity of investment. So interest sensitivity of investment will affect adversely the policy of increasing government spending. So if government increase spending, we might not necessarily get the sufficient increase in this. It will depend more on how sensitive is investment to interest rate, right? So keep that in mind. So shifting the IS, I've already spoken about this. So I think, so the IS curve will behave the same as above for a decrease in government spending. So if you decrease government spending, what will happen? Or a decrease in consumer confidence. So if we decrease consumer confidence, we are cutting consumption, and as a result, we are cutting our demand, and as a result, output will decrease, right? So if government is trying to reduce the budget deficit, i.e. increase taxes, it means that taxes, remember taxes is leakages. So if you increase taxes, it means that leakages are going to increase, right? Right, so in that light, then, is everybody there?
Yes.
Yeah?
Yeah.
You can,
Yeah.
yeah, okay, I'm just making sure that everybody is hearing me. If there is an issue, just say, Ezekiel, we can't hear you. Right, so the IS curve will behave the same way as above. So a decrease in government spending or a decrease in consumer confidence, which decreases consumption. In contrast, any factor that for a given interest rate increase equilibrium output, i.e. if you decrease taxes, increase government spending, or increase consumer confidence, your IS curve shifts to the right. So remember that. So summary of the good market so far. So the equilibrium in the goods market implies that output is decreasing function of interest rate. We know that it's downward sloping. The relationship is represented by the downward sloping IS curve. The change in factors that decrease or increase the demand for goods, given the interest rate, shift the IS curve to the right or to the left. So remember that. Well, practice all the formulation of the IS curve equation, both when y is dependent and when I is dependent. Think of the extension such that introducing input, i.e. this. So if you introduce your input, so we could make input endogenous or taxes to be endogenous as well, right? Instead of treating them as exogenous, you could actually change that. So we could actually now come back in our example here, and instead of just having tax here as a lump sum, we can introduce as endogenous. And we can introduce x minus m, where m is this, and calculate the other one, right? On the financial market, we saw that in the financial market, money supply is equal to money demand. That's where the equilibrium is. And money demand is a function of income and liquidity of money, which means if you increase your interest rate, your money demand will decrease. So the equilibrium requires that money supply be equal to money demand. We all know that, but we care about real money. So you write this as that your real money is a function of your income, real income, and interest rate. So the LM curve is derived as this, which is from your financial market. Now, remember that later in the book, we're actually going to say that there is what? The LM is horizontal. You need to understand what are the implications when the LM is horizontal. It means that output change is insensitive to changes to interest rate, right? So equilibrium in financial market implies that the interest rate is an increasing function of the level of income. This is one of the assumptions we're making, but LM actually can be horizontal. So remember that, keep that in mind. Read about it in the book. What does it mean? So an increase in the money supply, on the other hand, lead the LM to shift down or to the right, which results in a decrease in interest rate. So if you increase money supply, it makes your LM to shift to the right and decrease in interest rate. Now remember, when you decrease your interest rate, a lower interest rate is favorable for investment. So actually, monetary policy, it tends to reinforce even to cause investment to happen in goods market, which increase output even further through the multiplier effect. So keep that in mind. Right, so equilibrium in financial market, so I spoke about that, then I wrote, so we now have two equations. We have the IS equation, which look like that, and then we have the LM equation. So the intersection between IS and LM give the equilibrium. So remember that, understand it, and if you have a question on any of this, please send me an email about it. Now I'm gonna discuss fiscal policy activities and the interest rate. So if you decrease public savings or fiscal contraction, or fiscal consolidation, so that's called a fiscal expansion. So if you are increasing G minus T, that's a fiscal contraction, right? You are trying to make this smaller, it implies that's a fiscal contraction. And if you are increasing that, that is fiscal consolidation. So discuss the effect of an increase in taxes using the ISLM. So an increase in taxes shift the IS curve to the right, to the left, and lead to a decrease in equilibrium output and equilibrium interest rate. Taxes do not appear in the LM relation, so taxes do not shift the LM curve. So remember that, right? So when you're always talking about that, that's the most important thing. Okay, so a curve shift in response to a change in exogenous variable only if these variables appear direct in the equation, represented by the curve, example T appear in the IS curve. So this is just talking about if a variable is found in the equation, if it's changing, it will cause it a shift if it's on the right of the equation, right side of the equation. So I have this table. I'm not going to discuss a table because you can read the table and try to understand it, right? Using a policy mix. So when we talked about policy mix, we are merely mean that sometimes we want to increase output and maintain interest rate being lower. So government can increase government spending, that will cause our IS curve to shift to the right. At the same time, central bank increase money supply will cause the LM curve to shift to the right as well. Now remember, if you increase government spending, LM shifts to the right, interest rate goes up. But if at the same time we increase money supply, LM shifts to the right and interest rate fall. So you can actually increase government spending and increase money supply and increase output and hold interest rate constant. So that's why we need a policy mix. We kind of want to maintain interest rate not changing, but increase output. So we can do that, right? So that's what a policy mix is all about, right? So of course, sometimes the National Treasury and the central bank can come together to try to achieve a certain policy mix to increase output. So that's what this discuss. What else? So that's what I discussed here. So by increasing the monetary supply in response to an increase in income from MS to MS1, doing so then ISLM will move from A to C. So actually this is in the table. Now, let us see this when we have LM as horizontal. So in this slide, interest rate is increasing, but and output is increasing, right? So you are moving from what? You are moving from MS to that, you increase money supply, and then what has happened? Your money demand increase. You need to increase your money demand to maintain the same interest rate. So you are at A, now you went at B. So output did decrease. So remember this and understand what we mean. All right, so again, the summary. So the real money must be altered to keep the interest rate constant at a target as income changes. If the central bank set an interest rate target IA, then during the target period, the LM relation that describes equilibrium in the financial market is horizontal at the target interest rate, i.e. here, right? A contractionary monetary policy is an increasing in target interest rate. The central bank announced a new interest rate, so we are going to talk about IB here or IB there. What will happen in that is if the central bank set an interest rate target IA, then actually here. So if they to implement the target, the demand for output fall, the central bank must reduce money supply to MS. The LM curve is horizontal. So as income fall with demand, the central bank reduce the money supply. If the central bank increase the target interest rate from IA to IB, then the demand and output fall as interest rate rises. So it means as interest rate rises from here to there, what will happen is that your output, actually you are moving from there to there, output decreases as interest rate increases. So that is one thing you need to understand. Right. Okay, so LM relation when there is an interest rate target. So when you have an interest rate target, what does it mean? An expansionary fiscal policy, when the central bank has an interest rate target, it implies that the interest rate is a target is set at IA. The increase in government spending shift the IS curve to the right. The curve labeled IS as the real income rises and the real money demand rises. In order to prevent an increase in interest rate to IB, i.e. in this graph, if you want to stop this going there, what will happen? You need then the central bank must increase the real money supply to that. Note that the expansion to fiscal policy with a strict interest rate target will be much more effective as an increasing the level of output than the same increase in government spending when the central bank keep the real money